We've had a batch of positive data coming out globally, most notably the PMI and ISM numbers. Common theme coming out this week, though, is inflation. We've seen price pressures coming through in all that manufacturing data. How are you seeing the inflation picture, and how does that perhaps affect you as an investor?
We're a bit concerned about inflation this year. We think it's going to be a big deal in emerging markets in particular. CPI and PPI in emerging markets on a weighted basis is now over 5% for the first time since the middle of 2008. So that's a big deal. Now, why is inflation important? Most people will probably tell you that inflation is good for equities. I was listening to the previous guest and he was making those comments now. So it might seem counterintuitive that we actually think inflation is bad for equities. And the reason why we think it's bad for equities is we think that the inflation in the emerging markets will cause countries in emerging markets to start withdrawing some liquidity and increasing interest rates. So we saw Indonesia, for example, today raising some rates. China's been doing it for quite some time. And rising interest rates is never good for equities. There's a very strong correlation between rising interest rates and declining equity markets. And that's what we worry about, particularly in the first half of this year.
Well, we saw the ECB meeting this week to decide on interest rates. The President, Jean-Claude Trichet, leaving interest rates unchanged and saying that the inflation outlook is a little more benign as the year progresses. All eyes really, though, on the Fed and what the Fed's going to do on interest rates. What happens when they start hiking rates? What does that mean for equities, and particularly emerging market equities?
Sure. It's a good question. I mean, in a way, that's why I think what viewers should be thinking about is developed market equities this year, not emerging market equities. And the reason is exactly that. Food makes up 30% of the inflation basket in emerging markets, and food inflation is really where the big issue is. You've seen corn prices, wheat prices, they're through the roof, and it's causing real inflation pressure in emerging markets. Less of an issue in developed markets, which are much broader economies and have much broader inflation baskets. So we think that developed markets are going to have the ability to repair themselves with low interest rates for longer than in emerging markets where we think inflation is going to become an issue. That's one of the reasons why we think, with valuation is the other reason, one of the reasons why we think developed market equities this year outperform emerging market equities.
How long is that window, though, until we start to see developed markets starting to raise interest rates?
It's very hard to say. I mean, I would say the things that could potentially cause a rise in interest rates in other markets, in developed markets, other than inflation, is a repricing of risk. Okay, so we've seen a little bit in the banking sector where bank bond spreads have widened out. So even though the government interest rates isn't that high because they're keeping rates low, if the credit price, if you like, starts to widen, then you might see some effective tightening in those markets, even though the government isn't really raising interest rates. And I think that's the sign to watch for, which is why this structural or systemic risk in the European banking system with Spain, for example, is such a big thing to watch. Because if banks' credit reprices upwards, ultimately that likely feeds through into the economy, because banks are going to have to push through higher prices to lenders, consumers, because their own cost of funding is going up.
Well, we're going to get to banks in just a moment. First of all, staying with this rising inflation, what's the impact on some of the other asset classes? So looking perhaps at the bond markets, at commodities, also currencies.
Yep. Look, I mean, some of the reason why you've seen a sell-off in the rand and the bond market is exactly that reason. As investors get concerned about inflation, particularly inflation in emerging markets, they worry about rates going up in emerging markets, the bond market sells off. Okay, that's exactly what's happened in South Africa. And because bonds are such a big component of our flows, when bonds sell off in South Africa, often the rand goes with it. Okay, and that's kind of what we've seen in the last couple of weeks. So I think it's very important to watch emerging market bond markets. They have been a haven for people to put the carry trade on. Interest rates are generally higher in emerging markets, so you can borrow money in developed markets and stick it in an emerging market and earn a nice carry. If that starts to flip-flop, because you can also lose money on bonds. I think people forget if bond yields go up, then that money withdraws, and I think it could cause a big sell-off in the bond market, because there has been a wall of money that's hit the bond market in the last couple of years.
Do you agree with Russell Lamberti that we've seen some of that bond market outflow coming back into South Africa, into the equities market? Yeah,
it hasn't been great. I mean, I would have thought some of it would be recycled, but I think what's really happening is, and we can see this, in fact, Morgan Stanley had a investor conference in January of this year, so just a couple of weeks ago in London. And investors were asked, okay, so where do you want to put your money now? And 20% of them actually said emerging markets over developed markets. Okay, in September last year, the answer was 80% thought emerging markets would outperform.
So it's been a total 180-degree turn.
I think those investors are really looking again at developed market equities because they actually have been forgotten for quite some time here because they've had their own issues and emerging markets have been sailing through unscathed. And that tipping point seems to be happening this year.
Well, just looking at those developed market equities, it would look like the banking space is not one of the spaces that is going to be attracting cash. There is still a lot of problem with the banks. You mentioned the Spanish banks. How about the banks' results we've seen coming out of the US and out of Europe? Because it looks like earnings still very much under pressure.
Yeah, it's always interesting to watch the earnings of the banks because I think that they are a lead indicator for kind of general economic activity, financial market activity, and they haven't been great. So particularly in the fixed income trading divisions of some of these big investment banks, those are the businesses that used to drive the P&L of these banks, and it's really, really come back a long way. I mean, I think fixed income in the fourth quarter, the December quarter of last year, was down 30% on the December 09 period, whereas the bright spot is actually in equities. So it feels to me like the kind of baton is being handed away from fixed income to the equity business for some of these big banks, which is good for people like me, hopefully, who's in the equity business. But it takes a long time for it to sort of filter down into South African business.
South African banks, what sort of space are they in? Because they don't face quite the same regulatory challenges and the capital requirements perhaps that we're seeing for those offshore banks at this stage. We had a trading statement out of Investec yesterday, and that's one of those in-between banks where it's rated according to UK banks, although it is South African listed as well, and in a slightly different space from the other big four.
Yeah, look, I think Standard Bank and Investec, given their big trading businesses, particularly in fixed income in the case of Standard Bank, will continue to have some headwinds because there's just not that much going on in that market at the moment. But if you ask me generically about the South African banks, we're actually quite positive. We think they have had a couple of years where they were sort of bedding down the balance sheet. They had a bit of a recovery in the last year because credit impairments weren't as big. And now we think going forward, while loan growth might not be so good because the South African consumer is still under the weight of quite a bit of debt, so they're trying to delever their own balance sheet, we think some of the fee income might start to come through this year. So some of what you've seen in the retailers, for example, is some great results. People are still shopping in South Africa. So while they might not borrow to buy a house, they're certainly swiping their credit card, and that swiping of the credit card does generate fees for the banks, and we think that could be an important driver of bank stocks this year.
Which of our banks would you be looking at this stage? They all have, I think, challenges and they all have opportunities at this stage. First round corporate activity, Standard Bank, a bit of a clean-up at this stage. Nedbank could still be a takeover target. What do you like in our banking space?
Yeah, our banks analyst has an overweight on First Rand and Absa. For similar reasons, I think that those are the two banks that have potential for what we would call franchise improvement over the next few years. So effectively, the banks in South Africa have all traded as a group in the last 5 years. They've all gone up together and they've all gone down together. We think the next couple of years you need to pick your stocks very carefully in the banking sector, and we like First Rand and Absa. We don't like Nedbank. We think they do have a structurally challenged retail bank in particular.